Welcome, everyone. I'm Rick Bensignor, and this is the In the Know Trader webcast on StockCharts.com. This week, we're going to break down our show into two segments. The first part will be a follow-up from last week's initial learning session. And we'll talk about a frequently incorporated trend exhaustion indicator that we use, designed by Demark, and it's called the sequential model. And secondly, as we always do, we'll review some key charts on the markets and what our models are saying. Before we get started, though, with things, let's remind you that next Friday, February 8th, I'll be in Orlando, Florida, speaking at one of the premier individual investor conferences there is. It's called the Money Show. For those of you who are familiar with it, there are two big money shows a year, one in Las Vegas and one in Orlando, and this attracts thousands of individual investors. So Friday, February 8th, I've been asked to make two different talks at the Money Show. The first will be at 11:15 a.m. It'll be an educational presentation entitled An Introduction to Wall Street's Hottest Conversation, Behavioral Finance Theory. And in that 45-minute discussion, I will introduce the crowd to what behavioral finance is, both a little bit on the academic side, as well as some of its practical application in the marketplace. And then at 3:45 p.m. until 6:45 p.m., so a full 3 hours, I'm doing what they call a master class there. This is entitled Successful Trading from Start to Finish, New Tools, New Thinking, and this will really walk you through how to line up a trade from the beginning steps you need to do in first picking which security you're going to choose in the first place, how to establish targets, stop outs, and kind of from a psychological point of view, also keep you in the trade when things may not be going exactly as planned. But it's a very helpful combination of learning how and when to decipher, typically using your own body's physical and emotional responses when it's time to simply get out of a trade that's not working. So look, the Money Show, along with other co-branded seminars that the Money Show does, which includes the Traders Expo type conferences, registration for these are completely free for attendees. The only thing they'll charge for are master classes, which again are some of these 3-hour classes taught by experts in the industry. But this is a completely free show for those who want to attend the regular programming. And there's tons of regular programming throughout the day. In fact, it's consistently through the day. So if you can get down to Orlando next week, the show runs from the 7th to the 10th. Again, I'll be speaking on Friday the 8th. It's certainly worth going to if you can get yourselves down there and enjoy some of the sun and fun, because certainly here in New York, we're about to get blasted with cold weather within the next 24 hours. Looks like we'll be hitting minus temperatures by tomorrow. And I've got a son who's at Ohio State, where it's already predicted to be about minus 10. And I've got a nephew in Minnesota, where they say it'll be minus 25. And those are not including wind chills. So certainly Florida seems to be a pretty good place to go if you want to get away from sun. I mean, get away from cold, have some sun, and learn some really great things about improving results as far as being an individual investor. Let's start off today. I want to kind of continue a conversation we started last week, and as an educational component to this week's webcast, is this model that we use in the No Trader. And again, In the No Trader is my individual investor newsletter. You can check out inthenotrader.com if you want to learn more about it. This is one of the key models we use in analysis for making recommendations there. And of course, these are the same models I use in my institutional newsletter for top institutions on Wall Street who are consulting clients of mine. So I want to start off here by kind of getting into this model called sequential. It was developed by Tom Demark, probably close to, or I think it's kind of the early 1970s. So it's a good 45 years old. It's had minimal tweaks ever since, so it's still pretty darn close to the original model he developed back then. And I've got to say, the fact that it's been minimally tweaked in over 40 years shows the robustness of the model. And I can tell you that many institutional traders and portfolio managers on Wall Street use this. This is special software that needs to be purchased separately. It can be purchased through a Bloomberg. It can be purchased through CQG, which is the charting system I use. I'm not sure if they're still run on Thomson 1. So some financial advisors who have Thomson 1, I think, still potentially have access to this model in limited scope. But because this is such a core to what we do, I wanted to get more in depth into your understanding it, so that also just when we go through key market charts each week, you'll have a better sense of understanding what I'm doing. The cool thing about this model is, in and of itself, it's not a complicated model as far as how what the mathematics are behind where these numbers come from. So I want to first start off with the basic part of this model, because it's really kind of a two-step model. So the first step is called the setup. And the setup are what you see here with the blue numbers that show up either above price bars or beneath price bars. So we alluded and started touching upon this last week, but I want to make it more clear what this setup is. The setup is a mathematical relationship. In fact, this entire model is simply a relationship with 4 ingredients only. And sometimes they only use 3 ingredients in the model, and sometimes even 2. So this is not complicated stuff as far as how the numbers appear. More difficult is knowing when to actually use the signals, like many other technical indicators that come up with a signal. It could be a MACD crossover, but you take it or not. Same type thing here. Experience in markets makes a big difference in being able to decipher what this model is trying to do. And I will tell you that at its core, this model, in my opinion, and I've had access to this model and have been using it since 1995, is the best model I know of in the, let's call it the general world of technical analysis. It's really more about market timing than classic technical analysis, but I don't know a better model that can more effectively help you call turns in a market when they actually happen, instead of well past a peak or a trough in the market. This can actually call the specific peak and trough. So let's start off with the setup phase, these blue numbers. So I'm going to move my mouse, and let's just start here on the left side, the far left side of the chart. You'll notice that the numbers show up underneath the price bars. This means that each day that gets a number represents a closing price that is less than the closing price from 4 days prior. Now, this is a daily chart, so we're comparing days to days. So simply, each one of these days, numbered 1 through 9, closed less than the close from 4 days earlier. In order to complete a setup, which is 9 consecutive bars of doing this, or in the case here, in late May, we rallied 9 consecutive days, close above the close from 4 bars earlier. This move needs to be consecutive price bars. If it's a weekly chart, it's 9 consecutive weeks, close above the close from 4 weeks earlier, or close beneath the close from 4 weeks earlier. If any other weeks or daily bars or whatever time frame you're looking at does not clear, in the case of, let's say, the market moving down here on the far left, does not close beneath the close from 4 bars earlier, all prior numbers in the 9 count will drop off, and you'd actually get a move where a price bar would be labeled with a number 1 on top of it, suggesting that that price bar closed above the close from 4 bars back. So the key thing here is you've got to go 9 consecutive price bars, close less than the close from 4 ago, or close above the close from 4 ago. When you do that, when Demark created this model, he said you've at least moved enough in one direction to potentially identify that a trend has begun. That's the minimum requirement to potentially say there's a trend. So in the case of a market getting 9 closes above the close from 4 bars back, he said that's at least enough to potentially say this could move higher. It's not saying it will, but it's saying that the market has moved enough in one direction to potentially say there's more to come. And on the downside here, if we look at this June decline, moving 9 consecutive bars closed less than the close from 4 ago, says that we've at least moved down enough to potentially have a further down move. Now, ultimately, and we'll get to this shortly, the true signal in this model is getting to a 13 count, and I'll explain to you how we get to that 13 count. But let's go back to the basic setup first. In sideways markets, in a trading range market, we've often been able to decipher that a 9 count, either upward or downward, is typically all the market goes. And I've purposely added an RSI chart on the bottom here. And you can see that the peak here, which was a 9 count up here, is pretty darn close to the peak in RSI. The 9 down is pretty darn close to getting oversold and back up and forth. Now, do I ever use the RSI as a lone indicator to trade? The answer is not a chance. It is just simply one tool in a bag of tricks that, if it also says that we're overbought or oversold, may lead me to fade a move. But in and of itself, I can tell you, RSI, in my belief, is not a solid enough indicator to play off of simply on its own. It tends to work well like any oscillator in a sideways market. But in a trending market, you could get your rear end handed to you if you sell simply because you got overbought. It may have way more to go. In fact, I think it was, let me think. I don't remember if it was Larry Williams, who, of course, in this industry is one of the original kings of deciphering market movement, and wrote a book in, I think it was 1960s on, and it's the first book I read in this industry, How I Made $1 Million Trading Commodities Last Year. The title was something like that. So Larry Williams will tell you that an RSI that gets overbought is often the best time to actually buy, because it shows that there's enough strength that there's a real trend there. So that kind of goes against how most people think about RSI. And one of my goals in talking to you in my weekly webcast is to help teach you the way professionals use information in the marketplace, which is often very different than how individual investors do. And the difference is individual investors have a tendency to listen to the textbooks and read a textbook on, let's say, technical analysis, and then think that everything they read is just simply correct. And it's not. And I think professionals are much more open to the idea of these are indicators, they're not the holy grail. There is no holy grail. Anybody who advertises that there's a holy grail is just basically a con artist. There is no such thing. But there are certainly tools that can help sway the odds better in your favor, that what you're looking to do has lined up for the right time and place to actually do it. And that's what a model like sequential can do. So going back to the setup phase, in a somewhat trendless market that's trading back and forth in a range, and here maybe if I add something like MACD, it may be clearer. Yeah, that we're kind of more tightly in a range. When you go a month and your MACD indicator lines are kind of hanging out right on top of each other, it clearly suggests that there is no trend. And minor blips either way still can essentially be within the range. So what this is saying here is that a 9 count is potentially a turning point in a trendless market. The 9 count on the upside, also not a bad time to potentially do some selling. 9 count near the low, 9 count near the high. Now look what happens here. Now we sell off in September. Still kind of feels like we're in the same basic range. And when this did a 9 count, it was similar to where the market bottomed in May. And this happens to be, by the way, a chart of front month continuous 10-year Treasury futures. So you might have easily bought this, and for a week or so, you think like things are going well. It's kind of bottomed, starts moving up. But then all of a sudden, we come out of what had been the range, and we have a further decline. Notice that in this particular move, there are red numbers that showed up. And these red numbers are a continuation of the 9 count. They just count differently. So what a setup is initially intended to do is say a market has moved enough in one direction to potentially indicate that there's more to come. In this case, more did come towards the downside. And now we have what's called the countdown portion of the sequential model. So the blue count was the setup portion, and the red count is the countdown. What are the rules for the countdown? They're similar, but calculated slightly differently than the blue count. To refresh you, the blue count, the setup, 9 consecutive price bars close less than the close from 4 bars back. If price action continues to the downside, the mathematics and let's better said, the software will will start a fresh count, typically designated in a different color so you can tell the difference between the setup and the countdown. And what the countdown does is look for 13 bars that need not be consecutive price bars. The way the setup count had to be 9 bars in a row, the countdown portion does not. And each bar that gets a price in red has a close that's less than the low from 2 bars earlier. I'll say it again. It's a close less than the low from 2 bars earlier, assuming that we're working on a downward count. The goal of this downward count is to pick the exhaustion point. The exhaustion point is the 13th time that the close was less than the low from 2 bars back. But notice here in October, there's multiple bars that never got a count. Bar 7 is here. It took almost 2 weeks to get bar 8. Why? Because not one of these particular days here had a close that was less than the low from 2 bars back. When you ultimately get to the 13th bar, that the close is less than the low from 2 bars back, this model suggests that there's a higher likelihood that trend has exhausted itself in that direction. No guarantees, just like anything else in this business, no guarantees. What it does minimally say to me is this is probably a bad time to play the short side in what has been a declining market. And when Tom Demark first introduced this model to institutional clients, and eventually he went public with these over 20 years after he first developed the model, he would tell people, this is a bad time to be a seller in what's been a downtrend. A lot of people always looking for the greatest new edge or the holy grail of trading said, well, hey, if it's a bad time to be a seller, it's probably a very good time to be a buyer. And they often, as soon as they see 13s, flip positions and get long. Now, in this case, it worked perfectly. And we immediately did a 9 count to the upside, stalled a little bit, and then started going higher. And while we started going higher, we got a new countdown, the red count, which was ultimately looking for the exhaustion point that this 9 setup count indicated could mean that there's some real trend. But along the way, we actually got another 9 count and even a third 9 count. So after this first 9 count, we keep going higher in Treasury bond futures. We ultimately get to a 13 count one day before the high was made. And by the way, the horizontal line here is the stop out from the 13 signal. And just touching it doesn't stop you out. There's some rules that we can't get into today that would tell you how to actually stop yourself out if you crossed above this line. So not only did the November low show on a downside exhaustion signal, but currently the December 31st or January 2nd highs of the move line up with a 13 count to the upside. And notice we've been trailing off from there, indicating that this was potentially the peak to this trend here. Now, it gets a little more complicated because this 9 count still has an ability to create a 13, which is what you see here. We're only on bar 10 of this 9 count. And then this third 9 count even has its own ability to count to a 13. And to cancel these again, we'd have to sell off a fair amount here and break under or get to just about 119 in futures to drop these other red counts off and to say that there's still not a chance for this to keep going higher. Nonetheless, here's a quick view just looking at one chart that gives a good indication of how this model can be helpful. So that's the starting kind of basic introduction to sequential. As time goes on in other webcasts, we can get into more details on it and some of the strategies around it. But as we only have a total of 30 minutes and we're down to less than 6 in today's podcast, I want to move on to looking at what the markets are telling us right now. So the first thing we'll take a look at is the S&P. Where are you? Here you are. So this is a little bit more complicated chart. I've got more models than simply sequential running on it. There's the cloud chart here, certainly some trend lines, and the cloud chart has 5 lines in and of itself. I've identified this boxed area, which is virtually a 100-point S&P area from just about 2680 or so up to 2775, that I count no less than 10 different pieces of technical indicator models, or whether it's trend lines, retracements, Demark type of targets, the cloud chart. 10 different pieces of the puzzle fall into this, suggesting that that's a pretty darn significant resistance point. But if it's 100 S&P points, it also means it's darn close to 4%. So it's kind of a large area, and it's not going to necessarily be easy at all picking where within there is the top to this move. More importantly, is what I've told clients is this zone in here from about 2585 to 2511. If we pull back into February from the rally we've had from the December low, this is the zone I want to buy into, 2585 to 2511. That's my main buying zone because, as I explained to you last week, I believe that the lows in December, not just for the S&P, but for all global equity markets was the low of the move. And if you follow me on LinkedIn, you'll know also that I put up several comments that and explained why we think that low is the low of the move. And therefore, I do want to buy a pullback, and it seems like this area in here is the right place to do it going forward. So that's my thoughts on the S&P. Let's take a look at the dollar index first on a weekly chart. So as we showed last year, or actually 2017, a very clear 5-wave move down. We've labeled each one of the waves in a red rectangle. Notice that down here in January of 2018, I have a 13 signal that finished off the 9 count that was from August. This is a weekly chart. So this essentially nailed the bottom the same time we were making a 5th wave down. That got us long. We got long for institutional clients, the dollar index at about 89.25, and we rode it up to 94.25, right into this 9 count here. And often I'll exit a 13 signal from one direction with an opposite 9 count. Since then, it ultimately moved past that 9 count. We topped on a 13. 8 weeks ago, we told clients to get out of dollar longs that they may have on into this zone. It has pulled back since, and you can see over the last couple of weeks, we're really caught in between 2 components here. 1, 2, 3, pretty much 4 weeks and 5 weeks in a row. In between the conversion line, which is this magenta colored line, and this orange line from the cloud chart. Cloud chart's totally different model, has nothing to do with Demark, but we'll get to that in a different time. Let's also look at the daily chart. Notice that we had a 13 and 9 count here on the top. Daily charts had daily 13s at the same time the weekly chart had weekly 13s. Perfect chance for a high. We sold off into a 9 bottom. We turned neutral since then, and we remain neutral. And dollar is actually very close to breaking down. Let's take a look at gold. Everybody's talking about a potential breakout in gold. Here's a plain gold candlestick chart. You can't see anything on it. Look what happens if I add the sequential model. All of a sudden, we see a peak here last year in January, one or 2 days before the actual high, a bottom here. This 13.9 was early, double 13s here as it's building a base, and that helped us get bullish. We got back into gold at about 12.15. We rode it to 12, I think 75 or so, and we're out. Notice today is a bar 12. We could be close to a near-term top. Also, switch this to a weekly chart, and we're on a weekly 9 count at the same time the daily is potentially getting a 13. Combine those two together, and it says gold, even though people are saying gold's breaking out, this makes me a lot more wary about getting long gold right now. We're actually out of time, so we'll be back next week. We'll do our show from Florida. And this is Rick Bensignor, and thank you for watching the In the Know Trader podcast.
Is your portfolio positioned to profit from continued market volatility in 2019? Join over 100 investing and trading experts, including policy guru Steve Forbes, emerging markets icon Mark Mobius, America's best income investor Bruce Johnstone, elite energy analysis Stephen Schork, and trading visionary Tom Sosnoff at The Money Show Orlando to get the best ideas for protecting and growing your investment portfolio during 250 in-depth presentations. Claim your free pass now at orlandomoneyshow.com.